Hey everybody, welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today's the 4th of November. It's the day after the election. I've sort of laid off videos the past few days just because I figured everyone's a little preoccupied, and guess what? We're still going to be preoccupied right now since there's no true winner that's been declared. Such is life, but life does go on. Real estate goes on. I'm Randy Patrick, your host, putting the realism back in the real estate market here. Today, we are going to get into the FHA delinquencies. I speak about that often, and I picked up the most recent, I guess you could say, information on FHA delinquencies from September 2020. So that was made available end of last week. So we'll look at that right now. Again, if you're looking for any information on housing, that's all my content information right there. And also, if you're not already a subscriber, if you could please do me a great favor and honor and help my channel grow by subscribing, I'd really appreciate that. So thank you very much. So getting into the whole subprime dealio here. So FHA is subprime mortgage, all right? We know that FHA, I guess you could say FHA qualifications are lower credit scores. They allow low down payment on their loans, and they also allow higher debt to income ratio. So that, of course, over time is going to manifest itself in the real estate market like it's doing right now. And there's a group called the American Enterprise Institute, and what they do is they're producing a monthly report now on FHA delinquencies across the country. And I mean the country, they're looking at, like right here, the top 10 most threatened metros by FHA delinquencies. And they also actually have a top, we'll say, metro list. That metro list is 169 metro locations across the country that they're looking at. And we'll get into that right now. So basically what boils down to is the fact that, FHA delinquencies are increasing, and they're increasing month over month and year over year. So while Atlanta and Houston remain the metros with the highest risk from delinquency rates, rising FHA delinquency rates threaten homeowners' neighborhoods in numerous other metro areas across the country. While the share of September FHA delinquencies was nearly unchanged for the prior month, the share of serious delinquent loans continues to rise rapidly. And that's the situation here. So the way it kind of works historically with mortgages and delinquencies and foreclosures, etc., is the fact that the greater the delinquency, so in other words, the more serious you are, it's almost like inversely proportional is your chances of recovering from that, and getting current on your mortgage. So it's roughly FHA has, roughly 8 million loans outstanding in September. 17.5% were delinquent, and 11.5% were seriously delinquent. And that also includes loans in forbearance, etc. So we're going to get into the top 10 right now. So let's click the thing here. And just so you see, obviously, since July, we've gone from 17% to 17.4% to 17.5% delinquencies. And you can see that we've gone from 10.4 to 11.2 to 11.5% seriously delinquent across the entire FHA loan board. Now, why is this kind of important? Well, it's because this is one of the number one loan products out there is an FHA loan. And as I said, the reason being because the credit score requirements are less than a conventional loan. The debt to income ratio requirements, are typically, they're allowing higher debt to income ratios levels in an FHA loan. And also the need for the down payment when you purchase a home is roughly 3.5%. So you can see that this type of loan product will attract a lot of people who maybe don't have the best credit, the best income, etc., or a lot of savings to put a down payment on the property. This loan works in an appreciating market because it allows people to get into properties without putting 20% down, 10% down, etc. And what this also does is, with low interest rates, I think increases the risk factor when people jump into properties. And also with the 3.5% down, I guess you could say what sort of looking for, there's less skin in the game. And if you think about it, you buy a property today, you put 3.5% down, have to sell in a couple months, you're going to be underwater from what you paid for it because closing costs and commissions are going to be 7-8%, right? So you're you've sort of lost any equity position you have, which was only 3.5%, and now you owe. So this is why I look at these loans as being risky, but they're a very popular loan now, especially with housing prices, at record highs. So let's get into this, okay? So the 10 most, I guess you use 10 metros in 7 states present especially large risk due to FHA portfolios containing a high percentage of delinquent or seriously delinquent loans. The 10 most threatened metros in September 2020 were, and we'll go from the top, the Atlanta metro location was number 1. We've got Houston and the Woodlands, Sugar Land, Texas, number 2. Chicago, Naperville, Evanston, Illinois, number 3. Washington, Arlington, Alexandria, Virginia, the whole DC metro area, number 4. Dallas, Plano, Irving, Texas, number 5. Riverside, San Bernardino, Ontario, California, number 6. The Baltimore, Maryland area, number 7. San Antonio area, number 8 of Texas. Orlando, Kissimmee, Sanford, Florida, number 9. And where I'm currently at, Tampa, St. Petersburg, Clearwater area at number 10. Now, we're going to go look at the overall metros, and there's going to be a little bit of shifting on the top 10 here. But how they, I guess you could say, how they rank the top 10 was basically looking at total delinquency. So total delinquencies that were greater than 16%, also with the seriously delinquent component being over 10%, and a what they call a share or count of what we call share or count of metro lending in 2019. So it boils down to recent FHA loans that were issued if they have a share or count greater than 12.5%. What that means is that loans that were really issued in 2019 are already delinquent, which to me I think is a very telling sign. That means maybe underwriting wasn't done properly, or people didn't have reserves or extra funds. They just kind of squeaked in to get that property and their FHA loan, and now they're already delinquent, which they've been in the property for a year or less, basically. So not a good scene here. But that's kind of your, I guess you could say, your criteria to give us the top 10 most threatened metros based on FHA delinquency rates through September 30th, 2020. All right. So that's interesting. So now let's go to the overall sort of area here. And I look at this. I found this in the net. It's kind of funny that subprime 2.0, right? There's the home mortgage qualification standards, and the subprime borrower is typically below that. A quote I saw here was, subprime loans are a government subsidized entitlement. So that's what it boils down to. So the government is subsidizing people, potential homeowners, to get in to riskier loans. And how that plays out, well, I think we sort of know where that played out last time through with the subprime mortgage meltdown and back in the last housing crisis. So are we looking to have that again happen this time around? Well, we're tracking, if you take a look at, the actual 17.5% of all, I guess you could say, FHA loans are delinquent. 11.5% are seriously delinquent. So that's quite a bit. It's not 5% or 3% or 9% or 8%. It's, double digits here. Double digits, almost 20%. Now we're getting towards 20% on the overall total delinquencies, and we're 11.5% on the serious delinquencies. Every month, that serious delinquent level is going to go up, guys. All right? Simple. That's the way it goes. And this is just subprime. I'm not talking about, Fannie or Freddie or Ginnie Mae back loans or conventional VA. This is just the FHA stuff here, okay? So non-bank stuff. So again, this is just one loan segment out of a whole handful here. So we're going to jump into now. This is tough to read, and if you want a copy of this, just email me. You saw my email on the screen earlier. I'll show it up before the end of the video. Email me email me, request it. I'll send you the spreadsheet, okay? Simple as that. So what I wanted to do is I wanted to point out the fact that there's a lot of locations here that have over 20% of their FHA loan base are delinquent. All right, so the number one location is actually the Nassau County, Suffolk County, so the Long Island area of New York. 27.2% of FHA loans are delinquent. All right, number 2 is actually New York, Jersey City, White Plains, New York area. That's 26.3% are delinquent. Number 3 is Newark, New Jersey area, 25.5% delinquent. Number 4 location is actually, if I look across the board here, this looks like Fort Lauderdale, Pompano Beach, Sunrise, Florida at 25%. And I got to go to another page here. Number 5, I guess you could say, is at 23.7%. That looks like Bridgeport, Stamford, Norwalk, Connecticut. So, basically 4 out of the top 5 delinquency locations are kind of in the New York kind of greater metro New York City area, Connecticut, Jersey, New York area segment of the world on the East Coast there. The one outlier is Fort Lauderdale area. But again, if I go down the list here, we've got Atlanta, Houston, Chicago, Washington, Dallas, New York, New Jersey, Riverside, San Bernardino, Baltimore. Phoenix pops in there now. Again, this chart is actually, I guess, how they ranked it was by loan portfolio. So it was the size of your loan portfolio and the number, like the pay count of seriously delinquents here. That's how they kind of broke this down here. Or actually, no, let me retract that here. Looks like actually, I don't know what I'm talking about. Looks like they've messed around this a little bit here, but basically that's where they rank it. Okay, so you can, when you get the spreadsheet, you can look at it. It's got active portfolio, 30 days delinquent, 60 days delinquent, seriously delinquent, total delinquencies, in foreclosure, percent delinquent loans, percent seriously delinquent, and there's more of the spreadsheet. Okay, the LA area, of course, Tampa area, St. Louis area is up there. Okay, Orlando, Kissimmee, Fort Worth, Arlington, Grapevine. So on one side of Dallas, you've got the right-hand side, the Dallas stuff. The other side, you got the Fort Worth side here, right? Obviously, Philadelphia's up there. Vegas, Henderson, okay, 19.5%. The Philadelphia was 20%. Charlotte, North Carolina at 17.8%. Miami Beach area, Miami, 22.9%. Camden, New Jersey, where we've got 21%. So, Denver area is now at 16%. Cincinnati, Kansas, Cleveland. So, we're seeing the typical major metro locations, but now we're starting to see other locations gaining in the seriously delinquent component and the overall delinquency as well, too. So the point here is that this is going to increase, all right? So the government's still writing FHA-backed loans, still a very popular loan, and every month that goes on as we have, what's the word I'm looking for, is we have less, more and more income loss, more and more jobless claims, more and more furloughs and layoffs. A lot of jobs aren't coming back. A lot of employers are shutting down, or they're relocating, and they're reducing hours and reducing income for a lot of their workers. We're going to see more of this manifest itself. Again, this is just nicely, I guess you say, presented to us statistically because it's the FHA is doing this. But, it's the other loans as well behind the scenes that we're not getting all the information of because they don't have to produce it, of course. That, we're probably going to see a lot, again, we don't know where the seriously delinquents are in retrospect to the overall delinquency rates and things like that. Obviously, we see the forbearance numbers that are fluctuating, the forbearance in transition right now. And why I say transition, because you've got people who expired September, October, and they have to, we'll say, contact their lender to re-up for the forbearance plan. Okay, they have to re-up for it. So it's not an automatic you jump into it. So there's going to be a little drop off. I know last week it kind of picked up again because of that. I'm not going to talk about that today, but I just want to focus on FHA. And the point is, this is still growing, and this will be problematic. So again, the metro locations are just increasing every month with their percentages here. The point being with a lot of the FHA here is we're seeing significant double digits. So all these locations, I'm going down. I don't know if you can really see it on the chart there. We're over 10%. Like this whole first page here we're looking at, it's 16%, 17%, 19%, over 20%. I think the lowest I'm looking at here is 14.7%, and that is Pittsburgh, Pennsylvania. So again, when we're getting into double digits on things, we know that there's problems in the economy and future problems in these locations. If I start going down to, going down this list, and again, we've got 169 metros here. So it's going to be working its way down. You've got Salt Lake City, you've got Raleigh, you've got Rochester, New York, you know what I mean? We keep walking down here, Buffalo, we're in Columbia, South Carolina. I mean, there's all sorts of locations here that are having difficulty. And it's just going to get worse and worse depending on where you are here. What am I looking at here? It just seems to be that I just look going as more and more and more. South Carolina, North Charleston, South Carolina, Omaha, Nebraska, Greensboro, North Carolina, Oakland, California, Worcester, Massachusetts, Fresno, California, Augusta, Georgia. So we're going into still some major cities, but we're also going into some sort of tier 2 cities now too. I wouldn't call them major metros, but they still got a significant population of, I guess you could say, um, you know, FHA loans, and again they're showing double digits as well too. And again, we're into the mid-teens now, mid to high teens, if not areas hitting 20%. I see a couple 20% up there. If I look at Boston, 20%. You see, so and again, Bridgeport, Connecticut, over 23%. That was one of the top ones. So we're moving up in values here. Wichita, Kansas, Knoxville, Tennessee, Syracuse, Akron, Ohio, Port St. Lucie, Florida, Winston-Salem, North Carolina, Stockton, California. Stockton was actually one of the places that had huge appreciation and major depreciation last housing crisis, that had a ton of foreclosures as well too. Springfield, Massachusetts, Chattanooga, Boise City, Idaho. So Boise City, funny enough, Boise City is going to have looks like how much there? We got 12%. Now, what's going on in Boise? Well, in Idaho is the fact that a lot of people from the West Coast are moving inland, and that actually is, it's causing, property prices to increase. In those situations or those instances, does that make it tougher for FHA buyers? So if property values are increasing and they're buying with low DTI and low down payment, lower credit scores, are they getting set up for future problems down the road? So, who knows? I mean, you can make your mind up about that. But the point is, some of these locations where we're seeing, increased property values over the past year, and they've increased significantly, we're still seeing FHA loan delinquencies. And, when I look at that, I'm going, okay, well, everyone goes, so why don't you just sell your home? So if you're delinquent, sell your home, pay off your mortgage, and then, you don't have a potential foreclosure and you can move on. Well, remember what I said earlier. If you take an FHA mortgage and you're putting 3.5% down, and you're buying what I'm going to call it the peak of the marketplace, right? So you buy a home, you got closing costs on top of that, prorations, you're putting 3.5% down. If you have to sell and you've been in your home for a year, 2 years, 3 years, well, from a payoff perspective on your loan, you have hardly paid that off. The first number of years, as we all know, in a mortgage, a 30-year fixed rate mortgage, you're paying off interest. You're hardly making a dent in your principal, number one. Number two, if you have to list your property with a real estate agent and on the MLS to sell, you're going to have, 5 or 6% commission right away. You're going to have seller-based closing costs, okay? And maybe you got a loan payoff in there. I don't know. I don't know whether there's an FHA loan payoff if you have to sell early. So who knows? But the point is, you're putting 3.5% down, and you sell with having very little principal paid down, and you've got a 5 or 6% commissions, 2% maybe in closing costs all in. So what are you? You're negative 4 or 5. You're negative 3-4% to sell. Are you bringing money to the closing table? You're not doing that. So what do? You don't sell. You just stop paying, or you can't pay. You're delinquent, and then every month that you go delinquent, you're also burning up what little equity you may have, or any equity you have, because again, what we have here is the fact that every month you don't pay is a non-payment. It's interest, it's fees, etc., and all that adds into what's totally owed on your property, which means your payoff increases. So not only maybe are you losing out on just with a traditional real estate sale because of closing costs and commissions, now you're adding in all these extra months of non-payment, which is really increasing your principal and your what I won't call principal, increasing your payoff, which becomes more problematic for a homeowner. So you see, this is where people get stuck. And but here's the thing too, is if you pay off your mortgage, where are you going to go? Because property prices maybe have gone up since you purchased it, and inventory's down. So you've got nowhere to go, or nowhere cheaper to go. And are you going to become a renter? Now you have to figure out first and last month's rent, where you're going to go to, moving expenses. So all these things kind of compound the situation and make it difficult for people to move out or go different places, sell and buy someplace else, unless you're drastically downsizing. You've got some savings behind you, but my assumption, if you got some savings, you'd do your best to keep yourself current. So it's kind of a catch-22 situation here that we're in right now. This is what a housing bubble is. Now you've priced yourself out of the market. You've taken the government subsidized loan and you've boxed yourself into a corner here. So again, that's my perspective. Why I say it is because I've seen it so many times historically over the years. So again, Savannah, Georgia, again, it looks like Let me work my way down here. Um, Flip my page here. Okay. Again, I can't see it right away, but the point is, I'll do the best I can to pick it off here. Savannah, obviously, it looks like 18%. Harrisburg, Pennsylvania, Scranton, Pennsylvania, Youngstown, Ohio. You've got Flint, Michigan. You've got, Beaumont, Port Arthur, Texas, Provo, Utah, Pensacola, Florida area up there. Durham, Chapel Hill, North Carolina, Lansing, Michigan, Vallejo, California, Lexington, Kentucky, Myrtle Beach, South Carolina. Naples, Marco Island, okay, 20%. So that's pretty big time. I can tell you that the Naples area is a much more affluent and expensive place for property. So again, if you're getting into FHA loans, if 20% are delinquent, and Naples, Marco Island, 15% seriously delinquent of FHA loans, it's tough there. And now, listen, if you take a look at the loan count, there's not a huge loan count FHA, but the point though is that it's, again, the more expensive locations, there's more exposure you're going to have with the FHA buyers. Springfield, Missouri, Tallahassee, Florida, Ocala, Florida. So again, we're looking at, we're all double digits here, some mid, some are high, and we're just working our way down. What do we got? Next slide here. Again, this is our last sort of page there. And again, as I said, if you want, you can just email me and I'll send you the spreadsheet here. It's clearly easier to look at it in front of you than pick it off and what I'm doing here. But my point, though, is that, as we go down the list, you're going to see things like, oh, what's the last one? San Francisco, San Rafael. Okay, and they have very few FHA loan counts. Boulder, Colorado, same thing. Asheville, North Carolina, Wilmington, North Carolina, Kalamazoo. So again, it's just I guess Oregon, Reno, Nevada. I guess the way that it kind of plays out here. But the point though is that you're going to see this in every market share. You're going to see increasing in delinquencies, and pretty much everything is double digit delinquencies right now on the FHA level. Now I don't really count stuff like if you take a look at San Francisco, and San Rafael, California, you got under 1,000, FHA loans in that area. So of course, not the market for FHA loans because the FHA limits probably don't even reach your loan limits are probably hardly ever reach in those locations anyway because they're too expensive. But again, you can still see how that can affect various locations as well too. But the point I'm trying to make here is that it is what it is here, and this is only going to get worse. Now, is this a problem? Well, when you take a look at this chart here, this is the first two lines of the chart, and when I take a look at the total active portfolio is just shy of 8 million loans. You've got almost 1.4 million loans that are delinquent, and out of those 1.4 million loans, over 900,000 are seriously delinquent. So that's a pretty big number. And to me, as I mentioned earlier, seriously delinquent really is a future recipe for foreclosure. So that's kind of what you're looking for here as time goes on. Now, why do I talk about this? Well, what's my point to going through this? It's to show you what's going on in the marketplace. Now, all these FHA mortgages will not magically become current. And that is really the point I've always been trying to make here, is the fact that regardless of where property values go, all right, and this is the key factor here is, if property values are rising, as I mentioned, why don't you sell your property and, that you can pay for your mortgage and it won't be a foreclosure and we just have a transaction? Well, people can't always do that because, maybe they don't have the equity to begin with, or their non-payment has been chipping away at their equity. And if they sell, where are they going to go? They may get nothing out of the sale or very little, and for them to move doesn't make sense. Everything is expensive, so they just hunker down and stay in the home as long as they can, and they just put themselves in a worse situation. But regardless of government, who's in power, who's in charge, we're on this forbearance plan for almost 9 months now, right? April to where we are end of December. Again, forbearance doesn't fix all these. Forbearance and forgiveness is not going to fix all these problems, number one. Number two, loan modifications aren't. All these people who are not paying, who are re-upping for forbearance, who have income issues, aren't going to be able to take care of this stuff when their forbearance period is over. And these homes will then fall into the foreclosure bucket. It's as simple as that. We've seen it before, guys, all right? There will be issues. This is just a quick snapshot of the foreclosure calendar in the county where I live right now. And I know it's not huge because but it's starting to pick up. So we are seeing an increase in foreclosure auction sales getting set now. So some of the moratorium stuff has been lifted. The CDC has an eviction moratorium. It's more focused on tenants and renters as opposed to people who are facing foreclosure. So just, I mean, I can't show this every day, but every day more is added to this calendar. So because it's getting set, and we're starting to see increases. Now these numbers here were, ones, twos, and zeros, right? Now we're seeing, 11s, 20s, 16s, 18s, whatever. And this is just in the county I live in. If I go to different parts of Florida, like a Miami-Dade or Broward, that number is triple. You see, so stuff is coming back to the foreclosure calendar. It's not getting that much media play because because the general public's under the impression that nothing's happening because of all these moratoria that are in place, which is true, but stuff has been relaxed, stuff has been shifted around, and now lenders are going, if I can take it to sale and get judgments and get this property moved, I'm going to do so. So that's what's happening, at least in certain parts of the country. Expect it to pick up as time goes on. So again, my point always now is don't get a false sense of where the housing market is headed. There's, as we always talk now, the housing bubble bros versus the housing hype hacks. And, every time I look at the news, it's like, oh, housing's still good. We're looking at statistics that don't make sense or maybe aren't quite rounded out yet to show us that we're out of the clear here. We're not out of the clear here, guys. This will become problematic in the future. So if you don't believe it, that's too bad. I know what's going on. I see it in the marketplace right now, and I'm adjusting accordingly. All right. So as I always mention now, for those of you who seem to believe that I'm saying bubble crash, I think I've been very clear that I've changed my opinion on that, and I'm a big enough boy to admit maybe when I'm wrong or maybe I didn't see things right. And again, we don't have a crystal ball, but we have the time machine history. We can go back and look at this. So what we have now here, and I truly believe this, is we have two housing narratives at play. K-shaped housing market. We're seeing some markets that will increase in value and continue to increase in value because of relocation, because of wealth and market shifting, because of low inventory. And we'll have other markets that will be affected by FHA delinquencies and loss of people leaving, more tenants, like all sorts of stuff will happen. So we're probably going to see two distinct situations evolving as time goes on here. So how do you, as a consumer, investor, retail buyer, get into this? Well, you have to wait for it to play out, or you can start looking at off-market properties, distressed properties, shadow inventory properties. Foreclosures are starting to pick up. I've showed you that on the last slide there. Your real estate agent's not really interested in doing this because they don't have solutions for it, but we do here. Okay, so please keep that in mind. If you want more information, seek me out for a consultation. I can find out what I'm talking about, different methods to acquire property. Actually, on Monday night, I was looking at some stuff online. I recently became aware of something that makes the process that I implement even easier than what I had set up before here. And that's, I think, going to give us a big leg up with all these foreclosures that are coming down the pipeline here. So again, want more information about this, want to know what my special sauce is, I guess you could say, contact me to find out what I'm talking about. All right, last slide here. That's me. Send me an email, give me your information. I'll reach out to you. We'll get going on this. Thank you again for the views, likes, and comments. Reach out to me for more information and stuff I'm talking about here. We'll start doing some more videos now and get into some real nitty-gritty about what's going to happen in the housing market. So thank you for watching. Take care, and we'll talk to you soon.